Welcome to the debate here on Breaking News to Trading Moves. If a pilot gets, disoriented in a storm
Right.
and tries to pitch the nose of a commercial airliner into the ground, the plane's computer simply says no.
Yeah, it overrides the human panic.
Exactly. It overrides human panic because the mathematics dictate a climb. It relies on the instruments over human emotion. But on a trading floor, when capital is on the line, we expect individuals facing violent market turbulence to rely entirely on their own internal judgment. Today, we are asking if relying on that human element is a mistake.
Right. We are looking closely at the disposition effect, that very well documented, very painful tendency investors have to sell their winning positions way too early.
While holding on to their losing positions for entirely too long.
We have all done it.
Oh, absolutely. Exactly. The central question we are tackling is how traders actually conquer this pervasive error. I take the position that robust structural systems, rigid checklists, and, automated rules are the necessary mechanisms to bypass innate human biases.
And I take the opposing view. While rules offer a framework, true elite performance requires a biological, a neurocognitive adaptation to risk and regret. Mechanical structures routinely fail under stress unless the trader has systematically rewired their neural pathways to process uncertainty.
Well, let me set up my perspective on this. Emotional biases like regret and loss aversion, they are hardwired into our psychology. Research in behavioral finance demonstrates that the psychological pain of a financial loss registers twice as severely as the joy of an equivalent gain.
Yeah, the classic asymmetry.
Right. Because of this biological asymmetry, humans are naturally terrible at closing losing trades. We cling to declining assets to avoid the finality of admitting a mistake.
And we sell winners early just to secure the emotional comfort of a small gain.
Exactly. We have all been there. You are staring at the screen. The stock is down 15% and you tell yourself, I will just wait until it gets back to break even. Then I will sell.
That is cognitive dissonance in action.
Precisely. Therefore, the only reliable method for consistent performance is relying on external mechanical discipline, volatility-adjusted trailing stops, pre-planned checklists, systematic asset allocation models that remove the human element from the execution process entirely. You cannot outthink millions of years of evolution, so you must build systems that override it.
I come at it from a different way. Mechanical rules fall short because a trader under stress will simply override or abandon their own systems if they lack internal cognitive control.
How so?
Well, a stop-loss order only works if the trader actually allows it to execute. Look at the functional magnetic resonance imaging, the fMRI studies, conducted on professional stock traders.
The brain scans?
Right. These studies demonstrate that elite operators actually rewire their neural pathways over time. Professionals show heightened activity in the dorsolateral prefrontal cortex.
Okay.
That is the area responsible for executive planning, and simultaneously, they display reduced amygdala activation during high-risk decisions.
Less fear?
Exactly. Think of the amygdala as the fire alarm, screaming at you to run away from a losing trade, while the prefrontal cortex is the fire chief, looking at the structural floor plan and calmly deciding the best exit route. Superior trading is an internal biological reality, not merely a set of external guardrails.
I am not convinced by that line of reasoning because you are assuming the biological adaptation is the primary driver.
Right.
Rather than a byproduct of strict systematic execution. Let us look at the mechanics of managing winning positions.
Okay.
The disposition effect tells us traders sell winners early out of fear of losing the profit. To counter this, we use structural mechanics, like trailing stops. Retail traders routinely fail with trailing stops because they apply arbitrary, fixed percentages.
Sure, like a flat 5%. Exactly.
Say a 5% trail, just because 5 sounds like a good round number. So when the asset experiences natural market noise, they get stopped out right before the trend continues. But when a structural rule is properly calibrated using something like ATR, average true range, it changes the game. Average true range measures the normal daily volatility of an asset over a set period.
Right, but
Let me finish this thought. If a stock normally swings $2 a day, Your stop is mathematically placed outside that natural noise. You are not guessing.
Okay.
You are using the asset's own heartbeat to define your exit. It forces the trader to capture the full expansion phase of the trend, curing the disposition effect without requiring them to become some sort of Zen master.
That assumes the market moves in a predictable mathematical rhythm where a trailing stop is the optimal exit strategy. The reality is far more complex.
Is it, though?
Oh, absolutely. A trailing stop often acts as a mere crutch for fear. Research analyzing institutional performance shows that the very best hedge funds actively anticipate market conditions and drop their winning bets right before they turn bad.
Mm-hmm.
They do not wait for a mathematical trailing stop to be triggered by a reversal. This requires the ventromedial prefrontal cortex, the VMPFC, to dynamically evaluate subjective value in real time.
Okay.
This part of the brain takes in order flow, volume changes, macroeconomic indicators, and synthesizes them into an intuitive exit signal. A static formula just can't replicate that dynamic valuation. It lacks context.
Let me push back on that with the engine governor analogy. Think of a volatility-adjusted trailing stop like a mechanical governor on a high-performance engine.
Okay.
Even if the driver wants to push the engine to the point of destruction out of greed or slam the brakes out of panic, the governor mathematically prevents the catastrophe.
Well,
It defines the absolute boundaries of operation. Why should we trust a trader's subjective brain, which we know is heavily compromised by cognitive bias, when a mathematical boundary offers absolute protection against their worst impulses?
because the elite trader's brain isn't compromised in the way a novice's brain is. The governor analogy assumes the engine and the driver are completely separate entities.
They are.
No, in elite trading, the brain itself becomes a calibrated instrument. The nucleus accumbens, which processes reward anticipation, fires differently in a professional than in a retail trader.
Okay, but
When professional traders anticipate rewards, their neural activity is highly selective and refined by experience. They maintain a balance between reward-driven impulses and top-down executive control.
I still think
If you mandate a rigid mechanical stop, you actively prevent the expert trader from utilizing the exact neuroefficiency they have spent years developing. You are putting training wheels on a motorcycle.
exiting a winner early is frustrating. Sure, it is a luxury problem. But where the real severe damage happens, the kind that ends careers, is the paralysis when managing the losing positions.
Exactly. And this is where the limitations of mechanical systems become glaringly obvious. The reluctance to sell losers is driven heavily by regret theory and cognitive dissonance.
Yes, traders hold declining assets to avoid the finality of admitting a mistake.
Think back to the 2008 financial crisis. People held on to plummeting bank stocks because selling them meant accepting a permanent loss and admitting their initial thesis was flawed.
Right.
No mechanical stop-loss can function if the trader experiences a self-control conflict.
What do you mean?
What happens when the price approaches the automated stop? The trader feels the pain of impending regret, logs into their brokerage platform, and simply cancels the order.
Ah, yes.
They override the system to avoid the emotional pain of realizing the loss. The machine cannot protect you if you have the power to unplug it.
I see why you think that, especially looking at the 2008 data. But let me give you a different perspective on how we solve that exact vulnerability.
Okay, how?
The tendency to cancel a stop loss is why techniques like hedonic framing and strict trading journals are paramount. Hedonic framing is essentially the psychological process of segregating your gains and integrating your losses.
That sounds a lot like mental gymnastics.
No, it means structuring your mind to view a loss not as a standalone failure, but as a normal business expense within a broader winning system. You don't just set the order in the software, you externalize the entire decision-making protocol.
Right.
Consider the practices of top market wizards like Marty Schwartz. He utilized physical laminated checklists kept right next to his trading desk. When you are flooded with cortisol, your working memory shrinks. You literally become dumber. The laminated checklist acts as an external hard drive for your brain.
Okay, but
You don't have to remember your trading rules, you just have to remember to look at the paper. You frame the loss not as a personal failure, but as a statistical necessity of the system.
right.
The checklist is the authority. When the trader subordinates their ego to the physical checklist, cognitive dissonance is neutralized.
A laminated checklist is only ink on plastic. It possesses no enforcement mechanism. When a trader is facing a severe drawdown, the stress hormones like cortisol flood the system.
Sure.
This hormonal spike modulates activity in the amygdala and prefrontal areas, creating a dynamic interplay that heavily favors emotional, reactive behavior. A piece of laminated paper doesn't stop a cortisol spike.
It is a commitment device.
But the trader who survives that moment is the one who has achieved cognitive emotional decoupling. They've trained their brain so that the amygdala's fear response is suppressed, allowing the dorsolateral prefrontal cortex to maintain working memory and execute planning without interference.
Wait, you can't just tell me they adapt. How? If I am a trader listening to this, how do I actually decouple my emotions from my cognition?
It takes work.
You're making it sound like magic. How does one achieve this decoupling in a practical way?
It isn't magic. It is deliberate practice. It is akin to exposure therapy. Elite traders engage in simulated stress environments.
Like what?
Proprietary trading firms will literally have traders use biofeedback monitors while trading simulated markets with high volatility, training them to keep their heart rate down.
Oh, wow.
Yeah, they mentally visualize severe losses before they ever place a trade. Over years of taking small, structured losses, they desensitize the amygdala's threat response. They build literal neural pathways that associate taking a small loss with relief and safety, rather than failure and threat.
I see.
That is how you survive the cortisol spike. You're trying to solve a biological crisis with office supplies.
It isn't about office supplies. It is about creating a structural environment that bypasses the biological crisis entirely.
But you can't bypass it.
By relying on the pre-planned rule, the trader engages in what behavioral finance calls a pre-commitment strategy. You make the decision when you are rational, so you don't have to make it when your working memory is compromised.
But the decision to obey the pre-commitment is still made in the moment of stress. You cannot separate the execution from the biology of the executor.
Then let's scale this up to the institutional level, where we can look at how these factors play out over time among the most elite market participants.
Sure, let's do that.
If your premise holds up, that individual neurocognitive adaptation is the key to sustained excellence, we should see top traders maintaining their edge indefinitely based on their superior brain function.
Right.
Yet research analyzing top-performing hedge funds between 2001 and 2012 reveals a very different reality. Top quintile hedge funds maintain their superior performance windows for only about 6 months at a time.
Okay, but
Last year's performance rarely guarantees next year's results. This proves that individual neurocognitive edges are fleeting. Long-term institutional survival relies entirely on structural advantages.
like what?
Avoiding illiquid assets, managing the market premium, and utilizing strict momentum models without falling into the trap of momentum reversal.
I'm sorry, but I just don't buy that. Let me tell you why. That same institutional research points out that mediocre hedge funds have access to the exact same structural tools.
They do.
The same algorithms, the same momentum models, the same market premium data. Yet they fail. Why?
Well,
The research shows mediocre funds suffer specifically from momentum reversal. In other words, they hold on to securities for too long. They fall victim to the exact disposition effect we are discussing, despite having all the structural rules money can buy.
that is a fair observation.
Right. So the differentiating factor is entirely internal. The top funds monitor their successful strategies and cut them off the moment they start to go bad. That requires human judgment.
Or a better algorithm.
No, it requires a trained neuroefficiency, a separation of emotion-centric and cognition-centric brain areas that allows them to execute flawlessly under pressure. The mediocre funds fail because their managers lack this biological adaptation.
But wait, if the institutional tools are so effective, why do the mediocre ones fail?
They suffer from momentum reversal because their structural parameters are too loose, allowing human hesitation to infect the exit process.
You think it's just loose parameters?
Absolutely. When top funds cut a strategy that starts to fail, they are doing so based on predefined risk metrics. They recognize that outperformance is temporary, so they structurally bound their risk.
You mentioned that mediocre funds are all over the place regarding their risk factors. That points directly to a lack of systematic discipline. Elite funds isolate their exposure to specific factors like momentum and apply strict capital allocation rules. The discipline is in the architecture of the portfolio, not just the neurology of the manager.
The architecture of the portfolio is designed by the neurology of the manager. Let's look at another angle: trading frequency and attention.
Go on.
Research on institutional investors shows that they often exhibit an asymmetric allocation of cognitive resources. They spend vast amounts of attention and analytical rigor on the buying process, the entry.
But when it comes to selling, they rely on costly, heuristic-driven processes. This is why the disposition effect persists even at the institutional level. Overcoming this requires more than a structural rule. It requires reallocating cognitive bandwidth.
Right.
The trader must actively train their brain to apply the same rigorous, analytical processing to the exit decision that they apply to the entry. This requires breaking deeply ingrained cognitive habits.
Which is exactly why the structural mechanism is required. If human beings naturally allocate cognitive resources poorly, focusing on the hope of the buy rather than the cold reality of the sell, then we must automate the sell.
But you can't automate everything.
You set the stop loss, you set the profit target, or you program the trailing stop to size itself to the average true range of the asset. You don't ask the trader to manually reallocate cognitive bandwidth during a chaotic market session. You remove the need for that bandwidth entirely.
Okay.
By systematizing the exit, the trader is free to allocate their remaining cognitive resources toward what humans actually do well: pattern recognition and strategy generation.
That is a compelling argument. But have you considered how automated exits behave in anomalous market conditions?
Such as?
During rapid liquidity vacuums or flash crashes, static automated rules often execute at the worst possible prices, locking in severe losses that a human operator, utilizing their prefrontal cortex, would recognize as a transient pricing error.
Well, a well-designed system accounts for that.
The human brain, when properly trained, possesses a robust capacity for contextual reasoning that no automated stop-loss can replicate. The elite trader recognizes when the structure of the market is changed versus when it's merely experiencing high-variance noise.
A well-designed system accounts for liquidity and market structure. It doesn't execute blindly into a vacuum. It uses limit orders and structural invalidation points.
Still,
But let's bring this back to the core of the disposition effect. The research clearly shows that investors take irrational actions to minimize their feelings of regret.
yes, they do.
They engage in herding behavior to protect themselves from being singled out for poor choices. When a collective market bubble bursts, the shared regret is easier to absorb.
Right, herd mentality.
This herd mentality, this desire to avoid individual accountability, is deeply ingrained. A mechanical system forces accountability. It says, here is the parameter, here is the result. There is no hiding behind the crowd.
I agree that regret drives the herding behavior, but a mechanical system doesn't eliminate the regret, it just moves the target.
How so?
When an automated trailing stop takes a trader out of a position right before a major rally, the trader still experiences profound regret.
True.
That regret often leads to revenge trading, where they manually override their system to jump back in at a worse price. This proves my ultimate point. The mechanics mean nothing if the psychology is unresolved.
To truly master the disposition effect, the trader must confront the emotional response itself. They must achieve a state where they don't perceive a realized loss as a threat to their self-image, and where a missed opportunity doesn't trigger a cascade of fear of missing out. That is a biological and cognitive transformation.
We have covered a lot of ground today. I stand by the evidence that human beings are innately compromised by loss aversion, cognitive dissonance, and the fear of regret.
Right.
The biological pain of losing is simply too strong to consistently overcome through sheer willpower. Strict, well-calibrated mechanical systems, physical checklists, and automated execution are the most reliable foundation for trading success.
Providing an absolute boundary.
Exactly. They externalize the decision-making process, providing an absolute boundary against our most destructive emotional instincts.
And from my side, while rules provide a necessary framework, they are ultimately subordinate to the human mind operating them. The true differentiator of elite performance is the biological and cognitive adaptation of the trader. The fMRI data is clear. Professionals process risk differently at a neural level. They dampen fear and elevate cognitive control.
Without this neurobiological adaptation, a trader will eventually buckle under the stress of regret and override their own mechanical systems.
That said, I think we find a strong point of convergence here. Mechanical systems undoubtedly provide the necessary boundaries for survival in the markets, but a trader absolutely must cultivate the cognitive discipline to respect those boundaries when the pressure spikes.
Yes.
The machine provides the optimal path, but the human must still have the fortitude to walk it.
I completely agree. The architecture of the strategy and the neurology of the trader must work in tandem. A flawless system operated by an undisciplined mind will fail.
Absolutely.
Just as a highly disciplined mind operating without structural risk management will eventually encounter mathematical ruin. There is so much more to explore within the research on behavioral finance and neuroeconomics to understand exactly how we bridge that gap.
We leave it to you, the listener, to evaluate your own methods for managing risk and exiting trades. Think back to that airliner flying into the storm. You can build the most advanced flight protection system in the world, perfectly calibrated to prevent a crash. But if the pilot sitting in the chair hasn't trained their mind to trust the instruments when the turbulence hits, their instinct to grab the yoke and pull in the wrong direction might just bring the whole thing down anyway.